Okay. Can you hear me? Yes? Okay. Well, first of all, it's very good to be back in Lebanon, and thank you very much for arranging such very nice weather for me. It's very kind of you. I wasn't expecting it to be quite as warm and sunny as it is. Just to mention my background, I'm a collective investment fund specialist. I've worked in about 40 different countries of the world, drafting regulations or laws for collective investment schemes in countries ranging from, in size, sort of China and India and Russia, through to smaller countries. Would you believe Uganda has collective investment schemes, and so do a couple of other smaller countries, Vietnam included. I have worked in the region before, but not before now in Lebanon. So I've worked, for instance, in Egypt and in Qatar. And so I've quite a lot of experience of collective investment schemes worldwide. But of course, every country has its own differences. My task has been to draft regulations that align with the IOSCO standards. This is the international standards for collective investment schemes. And also to try to modernize some aspects of the regulations to bring them into line with the most recent trends so that Lebanon is able to adopt any of the new developments that are happening in other markets. What I'm going to do really, what we'll do now is just look briefly at the headlines of the regulation. I'm sorry, you've all had a lot of reading to do. It's quite a long regulation, but it's much shorter than many others, I do assure you. At the number of pages you will have here in Lebanon, it's still quite brief compared to some countries where you have 300 or 400 pages. So it may seem long compared to the previous regulation, but that's partly because we're trying for more clarity. And another reason is because the schemes you have here in Lebanon are contractual. And there is really, it's not like a corporate scheme where you can rely on what company law says in relation to meetings and shareholder rights and things of this nature. Where the contractual scheme is really you have to create the framework to be as secure as possible for the investors in order that they have confidence and they bring their money to funds and make investments. So, of course, what we start with is the basis of the whole regime, which is, of course, Law 706, and, of course, behind that, Law 161. A policy decision was made for now only to enable funds in a contractual form. The reasons for that are several, but one of them is that the tax position of a corporate scheme at the moment is such that it would not be very attractive to Lebanese investors compared to the contractual scheme, which is not a taxable entity. And so the corporate schemes will be dealt with at some point, but the decision was made to focus on the contractual schemes for now. And what we have looked to do is to enable three forms. Two you have in the existing regulation, open-ended and closed-ended. And the third one is the interval, which is a sort of hybrid between the two. It's a bit like, it's an open-ended fund technically, but it doesn't open as frequently as the standard form of open-ended fund does. And you will note in the regulation that the interval fund is redeeming once every 4 times a year, once every 3 months, while the open-ended fund is once every 2 weeks. That's the key difference. And the closed-ended fund does not redeem at all, except at the end of its life, if it has a fixed life. So what we've done also is we've looked at differentiating, of course, funds created here in Lebanon, domestic funds, from funds created outside Lebanon, and created, or rather distinguished, two regimes. One being for funds which are to be offered to the public, which can be bought by anybody, and one for funds which are only available to professional investors because they entail a higher level of risk of one form or another, whether it be concentration of risk or leverage or the type of asset that the fund may hold. So within domestic schemes, we have what we call approved scheme, which is for public offer, and then we have the exempt offer scheme, This exempt offer aligns with the regulations previously done on the securities regulatory framework. And then for foreign funds, we have again two categories, ones that could be permitted to be offered to the public here in Lebanon, and another category that are only to be only to be offered for foreign investors. Beg your pardon, for professional investors, sorry. Getting my language in a tangle, and I'm in my native language. Which brings us to the definition of a professional investor. The funds that may only be offered to this category, what are the professional investors, and essentially the definition is the same as it is for your securities regulatory framework. There's no differential there, but there is an additional requirement that the fund accepts only a certain amount, which is a minimum investment of $100,000. Now, why do we add that? Well, we are trying, as in many countries, to prevent what is described in English as the widows and the orphans, the vulnerable, to invest in schemes which take risks that they do not understand. And we're also trying to ensure that the type of investment available to professionals is one where they can understand the risks involved, but that comes down to disclosure, which we will talk about later. Now, essentially, just to take us fairly quickly through the headlines, because I'm sure you all have read lots of the pages of the regulation, maybe not all of it. It's a long regulation. I'm just going to highlight really the key elements of the different parts of the regulation. And essentially, the first part, A, is designed to apply to all collective investment schemes in Lebanon, whether they're domestic, created in Lebanon, or whether they're foreign and offered into Lebanon. And essentially, it requires both categories of fund to comply with the relevant parts of the regime in Lebanon. It requires the entity that establishes a scheme here to be an approved institution under the licensing framework for the securities regulation here. And it requires whoever offers the scheme here in Lebanon, if it's a foreign fund, to be an approved institution for that activity, because that is what your licensing regulation would require. It requires also that an entity that deals in the units of foreign schemes should be approved for that purpose. And it only allows a scheme that is approved by the regulator, which is the domestic scheme, or is recognized by the regulator, which is the foreign scheme. Only those two categories may be offered to the public, the others may not. And last but not least in that section, we also enable the entity which is the custodian. You'll notice the language in the regulation, we refer to CIS custodian and CIS manager. That's really just to make sure we have a clear differentiation between the language that is used in Law 161 and the licensing regulations under it. Because a CIS manager is not simply an investment manager, it is a fund manager. So we've tried to keep the language separate, so we have CIS manager and CIS custodian because they have different responsibilities to the entities that would normally be labeled investment manager or custodian. So we've just gone for that for clear differentiation purposes, not for any other reason. So that's part A. Part B, again, applies to all funds offered or created in Lebanon, and essentially requires that a foreign scheme is only offered in compliance with the regulation, that fees are payable in relation to the scheme to the authority as prescribed by the authority, that persons operating and offering a scheme must cooperate with the authority. I worked in Russia many years ago where a regulator went to inspect the books of an entity, and we are talking about Russia in the Wild West phase. We're going back maybe 20 years now here. And the regulator arrived and knocked on the door and said, "We've come to inspect your books." And the regulated entity said, "Yes." And they said, "Please produce the books." And the regulated entity said, "No." And the regulator said, "Well, you have to keep the books." They said, "Yes, but we don't have to show them to you." So this is just to have clarity on things. I've learned from bitter experience that clarity is useful. We then also have that the persons that operate a scheme have to disclose the necessary information to each other to enable the scheme to operate effectively, so that we make sure that if there's an administrator and a manager and a custodian and an auditor, that all of these are giving each other the information they need in order to do the job they are required to do by the regulation. Part C it moves on only to deal with the schemes that are created here in Lebanon. And that's whether it's for public offer or for professional offer, it applies to both. And it essentially sets the general requirements which apply to those two groups of schemes. And more detailed requirements are given in Part E, which Halil will talk about, which is the approved scheme for public offer. And Part C looks at these areas. The duties of the manager, that is the operator of the scheme in IOSCO language, for those of you who are familiar with their terminology, the entity that creates the fund, that markets the fund, that manages the fund's investments and administers the fund. It also deals with having to keep records for the scheme and the period for which such records must be kept. It deals with the need for an audited report and accounts for the scheme. It deals with keeping of the register, the list of the list of the unit holders, and also conflicts of interest which may arise and how these might be dealt with. Then we have the investment policy and practice. Now, bearing in mind that this section covers both approved and exempt offer schemes, that's both for public offer and for professional offer. What it says in this section is quite broad, and it really only requires a sort of prudent spread of risk. And that's the general principle that all funds in every nation have to comply with, otherwise essentially it isn't a fund. That's what they're there for, to provide diversification of risk. The more detailed requirements which the publicly offered scheme have to abide by are given in Part E, which we'll talk about in a few minutes' time. We have something here called delegation by the CIS manager. This again is an IOSCO provision that an entity that is made responsible for something is able to delegate a task, but they cannot delegate the responsibility. So if the manager is made responsible for, say, keeping the register, that is its responsibility legally, even if it may hire somebody to hold that register on its behalf and to administer it. Then we have provision for fees and charges to be able to made the scheme, and we have the power of the authority to remove and replace the CIS manager. This is in two different circumstances, one where the manager voluntarily wishes to cease the activity, and one where it's necessary for action to be taken by the regulator if there is a problem with the manager. And then we have the CIS offering document. This general term is used because while a publicly offered fund is required to have a specific form of documentation, the professionally offered fund may make a greater range of choice about what it decides to have as its documentation, and therefore the general term is used here. Part D deals again with only domestic schemes, and here we have requirements set for the custody of the collective investment scheme. And here we have set out the duties of the custodian. Again, bear in mind here we're dealing with domestic schemes, both for public offer and for professional offer. We have the ability to delegate custody. The CIS custodian is legally responsible for custody, but let us say it has to hold assets on behalf of the fund in another country. It may need to have a sub-custodian in that country to hold those assets, and that would be delegation in that case. We have the responsibility for the property of the scheme, that is, it's liable if due to its own errors and omissions there is damage to investors. We establish the ability to levy fees and charges for that service, Again, we established the power for the authority to remove and replace the CIS custodian on the same principle as for the manager. And then we also have a provision for removal of the custodian by the CIS manager. This is if the CIS manager wishes to change custodian. Typically, this is for commercial reasons. Sorry? D, there we go, yes.
Yeah, one more. That's mine.
Yep, over to you. Sorry, I thought I had one more slide. I beg your pardon. It's over to Halil now, and I will come back for the last couple of slides at the end.
Good morning. I get the fun part, obviously, which is the public offer. Part E applies to all collective investment schemes for public offer established in Lebanon. Application to the authority. Any person seeking to establish a collective investment scheme for public offer in Lebanon must submit an application to the authority. The applicant must be an approved institution licensed to manage collective investment scheme. As you may recall from the licensing and registration regulation, the conference that we made earlier, we've discussed and covered 5 types of licenses. One of them was the advisory, arranging, and managing, and this would be the managing that we're referring to. The application should include all information that is covered in Annex 1. Process and powers of the authority. The authority will consider an application within 40 days. The authority may carry out review or inquiry or require more information from the applicant. The authority may refuse to consider an application if the application is not complete or if the applicant does not provide the required information. The authority will make one of the following decisions. It will either approve the application in whole or in part, or approve the application with certain conditions, or it may reject the application. Whether the authority decides to approve or reject the application, the decision will be communicated to the applicant in writing. Approval by the authority as a sample of requirements. The name of the scheme should not be misleading. And if the terms guaranteed or protected are part of the name, then the guarantee should be provided by a third legal entity, which is totally independent from the manager and or the custodian. In the case of an open-ended or interval scheme, unit holders are entitled to redeem their units at a price based on the net asset value. In the case of a closed-ended scheme, the bylaws must contain a commitment to have the scheme listed within 6 months, or to have a provision stating that the established scheme is for a limited period of time that should not exceed 5 years, after which the portfolio would be wound up, liquidated, and the proceeds will be distributed to unit holders. A member of the Association of Certified Public Accountants should provide a written consent to act as an auditor to the scheme. Approval of a material change. The manager must notify the CMA of any proposed material change and shall only implement it if the authority has no objection within 15 days. The manager must seek the approval of all unit holders. Usually a material change requires an approval of 75% of outstanding registered unit holders. A sample of what would be considered as a material change would be something that alters the risk profile of the scheme, or an extension to the life of the scheme in case it's a closed-ended scheme, or an increase in an annual management fee, or a change that affects the unit holders' ability to exercise their rights, or would reasonably cause a unit holder to reconsider their investment. Following the approval of the change, the documents must be modified and a copy should be submitted to the authority. Notification to the authority and unit holders of other changes, and here we're talking about notifiable change. The manager must notify the authority in writing of any notifiable change within 10 days, and what we mean by notifiable change would be something along the lines of changing the name of the scheme or the address of the manager or the address of the custodian, or even changing the custodian himself. Cancellation of an approval. The authority may cancel the approval of a collective investment scheme for persistent failure to comply with this regulation. or a manager or an approved distribution agent may decide to apply to the authority to cancel an approval, and the authority, upon reviewing such an application, will either agree to cancel the approval or delay or postpone it pending further action. Termination of a collective investment scheme requires the approval of unit holders, the consent at an extraordinary general meeting. The consent of unit holders for closed-ended schemes is not required, especially if it has a fixed life. Reporting to the authority. The manager must submit a quarterly report to the authority on all the schemes or sub-funds under its management within 20 days of the last day of the quarter. Thank you. Participation in an approved scheme. The manager is responsible for the preparation and the content of the statute or the bylaws. The bylaws must, at a minimum, cover the information required in Annex 1. A unit holder is entitled to exercise all their rights, including but not limited to vote at an extraordinary general meeting. The statute must state that liability of a unit holder is limited to the amount or the value of the net asset value of the unit. The statute must state and differentiate and clearly define whether the scheme is an Islamic fund, it's an open-ended, closed-ended, or an interval scheme, as Sally referred to earlier. The bylaws must specify if there are different type of classes based on either the redemption fees or subscription fees, or a variety with the management fees, or if there are different classes based on the currencies that are offered. The statute must state that unit holders may request the convening of a general extraordinary meeting, provided they submit a document signed by at least 10% of the unit holders. On receipt of such a request, the manager must notify unit holders within 10 days of receiving such kind of notification. Permitted fees and expenses. Only the manager may impose a subscription or redemption fee, and it may be stated as an amount or as a percentage of the net asset value. The only payments that are permitted would be the cost of dealing, cost of borrowing, the annual management fee, the cost of the custodian, the external auditor, and the fees of the authority. The manager must pay all the cost of establishment of the bylaws or the prospectus from their own cost, and the cost of any material that may be required by the authority to complete the application for approval. The authority has the right to establish limits on the types and levels of charges that may be applied to schemes. Payment of income. Manager is not obliged to pay income to unit holders, and when we say income, it could be either as interest earned from debt securities or on capital gains, provided that this obligation is not stated in the prospectus. Investment powers. The scheme property must only be invested in accordance to this regulation and accordance to the bylaws, the prospectus, and the applicable laws. The manager of a scheme must not place scheme property on deposit with an associate unless the terms are equivalent to terms that could be reached with two independent parties. The manager of a scheme must not invest in securities issued by the manager unless it's stipulated in the bylaws and in the prospectus. Personnel of the CIS manager must not simultaneously serve as directors in any other company, the securities of which are held under its management. The manager must not invest in schemes managed by the same manager unless it's stipulated in the prospectus. The manager must not place scheme property on deposit with any entity unless it is an entity as a commercial bank licensed by BDL or a foreign bank with an equivalent regulatory status. The manager is only permitted to invest in a security. Did we flip the chart?
Beg your pardon?
That would help. We're getting there. Sorry, if we can go back. Yeah.
Again. Yeah, conflicts of interest.
Yeah. Sorry for that. The manager is only permitted to invest in a security whose potential loss is limited to the amount paid for it. The manager must not sell a security short, meaning selling a security which they don't own, meaning selling short. In case the scheme investing in real estate should only invest in real estate outside of Lebanon in countries whose sovereign bonds are rated investment grade, must ensure that the title to the real estate is clear, and must make sure that they hire an independent evaluator to evaluate the property. The manager of a scheme must only use derivatives or hedging to hedge, or futures to hedge against currencies fluctuation or currencies exposure. The manager of a scheme and its associate must not act as a principal when dealing on behalf of collective investment scheme under its management. And this is an important one because we've seen a couple of funds where the portfolio or the trading activity where the counterparty of the trading that goes on in the scheme comes from the prop book and vice versa. Breach of investment restriction. If the breach is due to an act of a manager, the manager must immediately notify the authority in writing and put steps and deadlines to complete such correction measures. And he should copy the custodian. If the breach is due to circumstances outside the control of the manager and has not been rectified within 5 days, then the manager should notify the authority immediately. The custodian must keep a record of all such kind of breaches, and the custodian must notify the authority if a breach has not been corrected within the stated deadline. Permitted borrowing. The manager must not borrow on behalf of an open-ended or interval scheme more than 10% of the value of the units in the scheme, and such kind of borrowing could only be used for redemption purposes only. It cannot be used to enhance the return or performance of the portfolio, and it cannot be used to distribute as income to unit holders. And the window or the period that such kind of borrowing is or will be allowed would be 80 days, and it could only be done by way of overdraft. In case we're dealing with a manager for a closed-end scheme, the borrowing could go up to 20%, provided that the nature and duration are stipulated in the prospectus. For a closed-end dealing or investing in real estate, the manager must ensure that no more than 60% of the value of any property is secured by a mortgage from a foreign bank. Limits on investment exposures. At any time, not more than 15% is permitted to be invested in any specific class of securities of any one issuer, except that this limit could go up to 35% if the investment is made in Lebanese government securities or in government securities of the G10. The scheme may only invest up to 15% in any other one scheme. In case of a scheme property, not more than 15% could be invested in any single property. A scheme is permitted to invest up to 100% of its net asset value in government securities, subject to a credit rating where the issuance is an investment grade and it is disclosed in the prospectus, and must not invest more than 35% of the NAV in the securities of any one issue. Concentration of ownership in an issuer's securities. A manager must not acquire securities carrying a right to vote on any matter that represent more than 15% of the voting securities. Investment conditions, open-ended and interval schemes. The manager must not invest in securities that are not transferable or in securities that cannot be liquidated quickly in order to meet the obligation of redemption. The manager must not invest in securities that cannot be reliably valued. The manager of an open-ended scheme or interval scheme must only invest in shares that are traded on a regulated exchange, regulated by the authority, or on any exchange that has which the authority has recognized its authority. The only exception would be to have a clear statement in the prospectus where they would state that the manager would be able to invest at least 10% of the scheme in securities that are not traded on an exchange. Index scheme. The index scheme where the manager must invest at least 90% of the fund in securities of a specified index, and where the index should have a sufficient diversified composition. Money market scheme. The manager must invest the net asset value of the scheme in debt securities, and the maturity of such securities should not extend to more than a year. 50% of such securities should have an expiry extending to more than 90 days. Fund of funds. The manager of a fund of fund must invest at least 90% of the value of the fund in other collective investment schemes, but is not allowed to invest in other fund of funds. If you don't mind. Thank you. Requirement for the prospectus. The manager is responsible for the preparation and the content of the prospectus. The prospectus must be prepared for each collective investment scheme, and in case we're dealing with an umbrella scheme, it must cover each of the subfunds. The prospectus must be clear and concise and could be either in Arabic or in English. The prospectus must contain information necessary for the investor to make a knowledgeable investment decision and should capture all the information included in Annex 1. The prospectus must be complete and accurate and up to date, and in the case of an open-ended or interval scheme, it should be updated annually. The prospectus must state the regular disclaimer which we have used before for the Capital Market Authority does not accept responsibility for the content, including the accuracy or completeness of such information, and CMA has also not assessed the suitability of the securities. Prospectus for a new scheme must contain details of any initial offer period where the duration should not exceed 20 days. And during that period of time, the funds should be placed on deposit and are not allowed, the fund manager is not allowed to invest this amount. The prospectus for a new scheme must state the minimum subscription that is expected to be raised, and the minimum should not be less than $10 million. The prospectus for a new scheme must state that if the minimum amount is not raised, then the funds should be returned within 5 days from the last days of the initial offer period. The manager must file a prospectus that has been modified with the authority within 10 days. Key information document, which is known as the KID. The manager is responsible for the preparation and the content of the KID. A key information must be prepared for each scheme and must be available on the website of the manager, and must contain information as to where the prospectus could be obtained. The annual report and accounts. The audited annual report and accounts should be approved by the manager and signed by 2 directors. The audited annual report and accounts for the calendar year must be sent out to all unit holders by March 31st of the next year. Audit requirements must be independent from the manager and the custodian. The authority may require the replacement of the external auditor if it determines that he does not have the sufficient expertise. Audit fee payable must be agreed by the manager, disclosed in the annual report accounts. Disclosure to unit holders and investors. The manager must provide the KID to every potential investor before they subscribe. The current key information, the prospectus and annual report, must be given to every unit holders or offered to every unit holders free of charge. The manager must send a subscriber or redeemer of units a statement of the number of units which they have bought or sold, including the net asset value. In the case of Lebanon, and if we have a firm selling a foreign fund, then it will be the responsibility of the placement agent to issue such kind of confirmation. A similar confirmation, which is the annual statement, that would show also the outstanding number of units, and the value of those units should be also issued to the unit holders. Subscription to and redemption from approved schemes. The redemptions must not be fulfilled unless the order is received 2 hours before the next valuation point. If the order is received after that period of time, then the order will be fulfilled at the next following valuation point. The manager must pay the redemption proceeds no later than the close of business of the 5th day. Limiting or deferring redemptions of open-ended and interval schemes. The manager may defer fulfilling a request of redemption until the next dealing day if the total of all unit holders' redemption requests exceeds 10% of the outstanding number of units. Suspension of subscription and redemption of units in open-ended and interval schemes. The manager must inform the authority and unit holders of any such suspension of subscription or redemption as soon as possible, and must advise the authority and unit holder of any resumption within 1 day after it takes place. The authority has the power to require ending of such suspension if they believe that it is in the best interest of investors. Securities advertisement and promotional material. Securities advertisement for a scheme must be consistent with the prospectus and must include how to obtain a copy of the prospectus and key information, and a statement that the value of the units could go up and could go down, and that the investor may not get back the money they invested. Securities advertisement must not include a projection or prediction of total return, and the manager must maintain records of all securities advertisements. Performance of an approved scheme or subfund must comply with the following requirements. Total return must be stated as net of any entry or exit fees and net of any annual expenses paid out of the scheme. The subscription charge, the operational expense ratio, and the redemption charge should be stated as a percentage of the net asset value. The total return must be shown for 1, 3, 5, and 10 years, but no returns may be shown for a period less than a year. Valuation and pricing of approved scheme. The manager is responsible for the valuation and for the calculation of the net asset value. As Sally referred to earlier, the calculation for now for a closed end, it should be done at least twice a year. For an interval, once a quarter, and for an open-ended, it should be done at least once every 2 weeks. If the unit price is incorrect by more than 1%, the manager must notify the authority immediately and the custodian. The custodian must give written notification to the authority if the manager fails to make reimbursement within the established deadline. If the net asset value falls more than 25% from the December 31st of the previous year, the manager should notify the authority immediately. Meeting of unit holders, we covered that earlier, but the only thing I want to touch on is that the manager may call an extraordinary general meeting at its own initiative, or if he receives, as we discussed, a document signed by at least 10% of the unit holders. Once he receives such kind of document, a written notification must go out to all unit holders, at least 15 days, but not more than 25 days, advising of the meeting, and must state the agenda, the venue, time, and date. For a proposed material change, it requires, as we discussed, 25% approval of unit holders. Lastly, every unit holder is entitled to appoint another person to represent him at an extraordinary general meeting through a proxy, and the meeting must be chaired by the custodian. The minutes must be taken by the manager and approved by the custodian. Sari, back to you.
Okay. Back to me just to finish off. In relation to a domestic scheme that is created for offer only to professionals, the exempt offer scheme, essentially the requirements of this section in in Part F are quite light. Really, they're concerned with, in effect, ensuring that certain things are disclosed in the offering document for the fund and that investors are aware of what the risks are entailed. It does not set out very detailed requirements. It's assumed that professionals dealing with professionals will form their own judgments. But they are, however, not permitted for public offer, these particular schemes, and therefore the requirements that are placed upon them are not the same as those that are placed on those that are going to members of the public who need more explanation as to how things work, as well as the risks involved. Essentially, the regime here will be that the fund that is proposed can notify the regulator, or rather will notify the regulator, preparatory to any offer being made. If the notification has been made and no objection has been received within 15 days from the regulator, the scheme will be able to proceed. So it's a much lighter regime than is required for the publicly offered scheme. Then we pass on to look at the offer of foreign schemes here in Lebanon, and indeed there are many foreign schemes that have been listed here as being able to be offered here. Essentially here we're differentiating again between a scheme that we called recognized, that is, it derives from a country or a territory whose regulation is recognized by the authority, the CMA here, as offering equivalent investor protection to the Lebanese framework. And if a scheme meets that requirement, then it can be accepted for public offer in Lebanon, but it must nonetheless be recognized by the regulator before that can be done. And it essentially would mean that because it would be equivalent to the Lebanese regulation, that would mean use of derivatives only as Halil has described, and therefore any more sophisticated or different use of derivatives would not be permitted for a publicly offered scheme. It could be an exempt scheme, for a foreign exempt scheme offered to professionals, but it couldn't be a recognized scheme for offer to the public. The foreign exempt offer scheme, again, is for offer to the professionals only, and here again there would be a notification process to the authority which has 15 days to object to the offer being made in Lebanon, and if no objection is received, then that offer can proceed. Both the recognized scheme and the foreign exempt offer scheme would be required to have an approved distribution agent here in Lebanon, which is where investors can get information and where they can transact in units, and where, if necessary, they can also go to find prices for units. The notification is based on a no objection process, as it is for the domestic scheme, so long as no objection is raised within 15 days of notification being made, then the offer can proceed. And last, but perhaps not least, we have provision for a transitional period, because clearly when you introduce a change to regulation, there are existing schemes, whether domestic or foreign, that are being offered in Lebanon, and it will take time for the compliance of existing schemes to come into line with the new regulation. Essentially, it's envisaged that the new regulation would apply for any scheme created here in Lebanon after the date it's adopted, and indeed for any offering of any scheme after that day, after the date of adoption. But the operation of existing collective investment schemes that work here now in Lebanon would be given 18 months to come into compliance, because it can take time to achieve this, particularly if you have to have any form of consent from your investors. That can take quite a long time to achieve. The offering of foreign schemes, again, will have to comply with the regulation from the date of its adoption. And the public offering of a foreign scheme will not be permitted until the regulator has confirmed its status as to whether it's a recognized or exempt scheme. So in effect, all foreign schemes will become foreign exempt offer schemes until such time as the regulator has accepted that they could be made, an offer of those could be made publicly as a recognized scheme. So that concludes our rapid canter through the regulation. I apologize, we can't possibly all cover all matters of detail in our presentation. You'd be sitting here all day, and I'm sure you wouldn't want to do that. But if anyone has any queries, of course, about the details, I'll be happy to try and answer them, or Khalil. We've tried really to highlight the key factors of the new regulation, the key elements, and if you have any comments or queries, we'd welcome those.